Afternoon, everybody, and welcome to our first post-budget webinar, which is specifically designed for business owners. So today's session, I'm joined by Ian Goodwin, who's Head of Employment Taxes, and he's going to discuss the changes to the National Minimum Wage and National Living Wage, as well as the taxation of double cab pickups, popular topic. I'm Zoe Davis. I'm a private client tax partner, and I'm going to cover changes to inheritance tax, in particular around agricultural property relief and business relief. And I'll also talk about some capital gains tax changes. And then Paul Joyce, our M&A partner, is going to explain how these can affect the sale of a business. So before we begin, a little bit of housekeeping. Please use the Q&A box to submit any questions you have for our panelists. We do have a few that have come through already as people registered, so we will get to those as well, but please feel free to add any more as we're talking if you think of them, and we will address those at the end of our discussion. This is being recorded and a copy will then be sent to you via email. So let's go straight to Ian. We've got these increases to the national minimum wage rates and to national insurance contributions as well. Can you talk us through, Ian, what does this mean for business owners, particularly in terms of rising costs, pension contributions and adjustments to reward strategies? Lots to unpack there.
It's a massive change. I think the biggest kind of shock on budget day was probably the reduction in the secondary threshold for national insurance. That's gone from 9,100 to £5,000 per employee from April 2025. And what that means is for basically every employee in the UK who earns £9,100 or more, there'll be at least £615 more per year that the employer has to pay national insurance on each employee. On top of that, we've seen the 1.2 percentage point increase in employer national insurance too. So going up from 13.8% to 15%. To give an example, if you've got someone who's on £30,000 a year, £615, you're going to have another £250 of employer national insurance to pay. So £865 of employer national insurance to pay in addition to what you were paying already. So a big, big change for employers. And we've seen lots of press over the last week or so from the big supermarkets, from large employers across the UK, whether they be in hospitality, manufacturing or elsewhere, who are trying to oppose this and say this is going to kill business, it's going to reduce jobs, it's going to make us change how our business work. We're going to have to pass these costs on to the consumer at the end of the day. So there's a lot for organisations to think about here. Separately, as you alluded to, Zoe, we had some national minimum wage increases. What that means is that for people on minimum wage or who pay minimum wage, we're going to see some changes. And that's going to increase the general rate, the rate for those aged 21 and over is going up from £11.44 to £12.21 an hour. So 6.7% increase. Another big cost. Will organisations be able to increase everyone's pay by 6.7%? I'd say it's unlikely with the national insurance. So a lot of organisations are going to think, well, how do we pay for this? Where do we need to best place our employees? And what do we do around reward generally? Lots of things to think about there, I would say. Just to, I suppose, reiterate on national minimum wage as well, we are seeing changes to the lower rates of minimum wage for those that are apprentices under 18 as well, and those that are 18 to 20. They're going up by a bigger percentage, but they're still lower than £12.21 an hour. So again, things for people to think about.
Wow, a lot to think about. So we've had some dust settling, I'll say, on those IH. In fact, Ian, you didn't talk about double cab pickups.
I've not talked about them yet. No. I'd say I suppose getting onto cost mitigation factors, they're probably more important first for the national minimum wage and national insurance. There's not much you can do around national minimum wage because you need to pay it, but there are certain ways of thinking about, well, what pay qualifies for national minimum wage and what controls can we put in place to make sure we're paying national minimum wage? So those are things we have been talking to organisations about. For instance, things like, does the overtime premium you you pay, does that count towards minimum wage? It won't do, but other things might do, like certain bonuses, normal pay you pay. So we have done some exercises with organisations to see how they can redress the balance to be better from a recruitment and retention perspective, but also be as compliant as possible with the minimum wage regulations, particularly as HMRC are increasing their number of compliance reviews at the moment in that area. So a really important thing to do. From a national insurance perspective, there's quite a lot you can still look at here. We've got salary sacrifice arrangements. We need to be mindful of eligibility for national minimum wage purposes. So things like pension, things like electric vehicles, holiday buy, all those good things can help people mitigate costs. I was doing a quick analysis for a client yesterday, and I worked out they had about 250 employees, average pay about £30,000 per head. The increase in national insurance is probably going to give them about 225 grand increase overall for that. But if they introduce pension salary sacrifice, that's going to recover about 50, 60 grand's worth of that. So there's about 25, 26% they're going to get back. And they'll also get the employment allowance now of £10,500. Not available to every employer still. So if you're a one-person company or if you do a lot of services in the public sector, you still won't be able to get it. But it means that all larger organisations will now be able to get an employment allowance. If you're in a group, you'll only be able to get one. You can't get many, so you can't do things to separate your business up. But there are things you can do. And lastly, there are things around how you can mitigate national insurance as well on the type of worker you have. So if you're engaged qualifying apprentices under the age of 25, there's no employer national insurance on their pay where they're earning less than £50,270 a year. So some organisations should really look at how they structure their training programs to see if they can encourage more apprenticeships throughout the organisation and potentially reduce their national insurance bill that way as well. So there are some ideas and some things there that organisations can look at alongside certain that are specific for certain employers. So trunk arrangements where you pay tips and gratuities in the hospitality sector. Introducing one of those can save national insurance, as can if you pay car allowances and aren't paying at 45p a mile. You may be able to save national insurance there too, and we are working with lots of clients on that at the moment. You mentioned double cab pickups, Zoe. One of my favourite topics has been for a while. Is it a van? Is it a car? It's over a ton payload weight. It's currently a van. The last government tried to change that to say it is a car. Massive opposition in February, got rechanged. This government, in the small print of the budget, have snuck it through. So from next April, double cab pickups over a ton will be treated as a car. There are some transitional rules, mean that there will be some protection from 2029. But there's been a lot of press on this saying they're getting at the agricultural sector for reasons that you'll come on to, Zoe, I'm sure. But this as well, if you've got a double cab pickup, £50,000, currently there might be no benefit in kind tax you're paying because you're using it as a van to get to work and back and for business purposes. Come April, if you've got a new vehicle after April that you buy then, so transitional rules don't apply, potentially 11, 12 grand tax bill for you to pay, as well as 4 or 5 grand in national insurance as an employer. So big cost update there, and one that organisations really need to take seriously.
Thanks, Ian. I think you've given our business owners a lot to think about there. Is there anything else that you think employers who are business owners should be mindful of following the budget, or have you given us enough?
I think that's probably enough overall. I mean, there's changes to electric car rates with 2% at the moment for benefit in kind. They will go up to 9% in 2029, so up 1% every year, and then from 2028 they'll go up 2%, so 7% and then 9%. Something to watch. Still probably advantageous, I'd say, particularly with a salary sacrifice arrangement for organisations and individuals. And the other bit is we are seeing HMRC and the government invest in compliance. So make sure you're doing the right thing. Look at your tax behaviours, look at your tax strategies and risk registers to make sure you have got the right controls in place. And if you haven't had a review over recent years, you're more than likely to get one, whether it be a focused IR35 review, a national minimum wage review, or a more general employer compliance review. We are seeing them more out in force at the moment, and it's good to make sure you've looked at those proactively to reduce any penalties that could be charged and get in front of it rather than wait for a knock on the door.
Yeah, we know how important that is. Thank you, Ian.
No problem.
That is Really helpful. So I'm now going to touch on inheritance tax, and it's a real morbid subject. And I'm smiling away as I'm talking about it. Yet it's quite a difficult subject, and it's a really emotive subject actually. But the changes to inheritance tax for business owners were really significant. So I want to talk about that with you. And what I'm talking about here is business relief and agricultural property relief for inheritance tax purposes. So I just want to touch on what those changes mean for our business owners, what the impact is of these quite significant changes. So to remind everybody of the headlines, or to let you know if you haven't seen it yet, broadly, we previously had unlimited 100% relief where you qualified for business relief or agricultural property relief from inheritance tax, which is otherwise charged at 40% on death or on certain lifetime transfers. But from 6th of April 26, we have a £1 million combined limit for agricultural and business property, which attracts 100% relief. After that, the relief is reduced to 50% for any assets over that £1 million mark. So this is a significant change for our mid-market business owners, and planning before 6th of April 26 is going to be really important. So we need to think about succession plans now to be ready for that change coming in. So to start off with, I wanted to have a bit of a positive spin on this is let's reflect on what we still have. So we do still have a relief that exists and provides us with effectively 40% relief up to £1 million and 20% relief thereafter, which is not to be overlooked. And historically, I have seen that this can be taken for granted, overlooked, and in some cases just not maximised. Some business owners just assume it applies in full when it wouldn't, or they assume it doesn't apply at all when some restructuring could secure it. So I wanted to share some of those things with you, so you can reflect on those in your own businesses and hopefully pick up some hints and tips. So my first point would be to consider your current business profile. Do you qualify? If you do, is that in full? If not, can adjustments be made to maximise that relief? So the types of things you want to be looking at here is, what are we talking about? Are we talking about a single company, a single entity, or have we got a group structure? It might be, if you've got a group, for example, that you've got a holding company that doesn't really qualify as a holding company for these purposes. It might have an investment portfolio. We see that a lot. Cash that might sit there, you start thinking, actually, I can put that somewhere to do something better for us. And before you know it, that becomes a question mark from these purposes, whether it could be an accepted asset, maybe, or if it could produce relief entirely if it's huge. And it's always a case-by-case basis. But it could be the trading company itself has significant non-trade assets. It could be there's excess cash in, over and above working capital, or perhaps this is the regular one, a property that was once used in the trade that wasn't needed anymore, so it was let out, and it provides a rental income. Where do these assets sit? Do they exist? The other angle, have you considered the value of goodwill? And we often see this when we're thinking about whether relief is possible at all, and the extent to which that it's often not on the balance sheet, and it can be a really significant asset for business owners. What would you actually sell your business for? Does it exceed the number on the balance sheet? And often it does, and therefore we'd be looking at another effective trade asset that we can consider when we're looking at this relief. So that's definitely one worth looking at. The other thing I would be thinking about is the difference between trading and business. And people often use these interchangeably, but actually for this legislation, they are very different things. So what is your trade, and what is part of your business? And trade is a much higher threshold than business. But where trade applies, there could be a business that is wider that doesn't quite qualify as a trade. So thinking about a property business, a property letting business, wouldn't be a trade, but could very well be part of a business. And these are all things that you can piece together in order to consider what your business or your group might attract by way of business property relief. There's a lot here, as I hope I'm helping you understand. And I would definitely advise you as business owners to ensure you fully understand your exposure and where this could be further maximised. Moving on to the changes then. Now we've got this restriction effectively to the relief. I think what we now need to think about is accelerated succession planning. We don't currently have a limit on gifts out of excess income, which are immediately exempt from inheritance tax, nor do we have a limit on potentially exempt transfers, which start our 7-year clock for inheritance tax. So in any event, there's more of an incentive to hand over the business during lifetime rather than on death, which would usually be where people would sit. But you do need to consider any capital gains tax exposure here. If you're gifting something other than cash, can we fully cover that? Are we going to have a CGT charge when we gift over? It's one of those where people just assume there would be no charge because they assume it would be covered, and it's not that straightforward. You do need to do a calculation of what the business looks like that you're handing over the shares in. The other reason it's not so straightforward, not just in from a capital gains tax and wider tax perspective, is just thinking about asset protection. This is a really key area for a lot of people, that they might be concerned about handing down to family members and worrying about perhaps a future divorce or something that's unforeseen, and being concerned about giving those assets to those individuals. So therefore, this isn't just a straightforward fix and needs to be considered in the round. It might be appropriate from that perspective to consider using trusts, and where relief is currently available, and you could think about then how the 10-year charges that might exist on a trust could be funded in due course. Maximum of 6% of the value could be an attractive option for some individuals, especially where asset protection is key or where it's too soon to be passing assets on directly. So that's something that you could factor into that planning. The other angle to really think about here is what is the value of your farmland, or what is the value of your business, in order to understand the exposure that we're even looking at to start with, whether that's to inheritance tax or whether that would be to capital gains tax should you choose to sell it. And getting a professional valuation is a really good starting point for planning. Even if you do already have a valuation in mind, it can help provide comfort or give you a different number to be thinking about. So as you can see, there's going to be real complexity here in the detail of the inheritance tax reliefs, and it's just not going to be as straightforward as it once was when you're thinking about your business or agricultural assets and passing those through. One aspect that is going to be important to think about is funding. So if you are thinking about passing down lifetime or on death, how are you going to fund any IHT charge that's going to arise? And this is going to be, I think, more prevalent now with these changes. One of the questions are going to be, have we got liquid assets in the estate? Have we got life cover? Have we got insurance? This all needs to fit into a much wider plan to think about when you're actually starting to question, are things still fit for purpose in the new environment? But actually, I think one of my top tips, which might be odd coming from a tax partner, is to forget the tax. When you start thinking about your succession planning or rethinking about your succession planning, being triggered by these changes, the first thing is, what are your wishes for your loved ones, for your family, for the people that you want to inherit from you? Just think about that as a topic to start with. Who do you want to benefit? Do you have any concerns? And that might be you're thinking about asset protection, concerned, as I mentioned, divorce or anything like that, or capacity for future generations to make good decisions. That's often one that comes up. People saying, this generation hasn't had the same education that I did in finance, and I'm worried about them, getting control of assets too early. These are all very normal and very real considerations and incredibly important. And if you start there, what do you want? What do you want to achieve? What do you want for your family? What do you want for the friends that you want to inherit? And what are your concerns? And get all those out on the table. A structure starts to show itself. And then you work out the tax exposure from there, and you can start looking at the different things you might have and the mitigation options you've got. And they're the best plans I see from a succession perspective. And you can edit from there. There are so many things to think about, and honestly, every business is different, every individual is different. A different plan will be appropriate for everybody. One of the other things to mention here is you're always thinking about this. As a tax person, you're always thinking about this. Which tax do I want to pay and when? Two that interact really, really well is inheritance tax and capital gains tax. So considering the changes we've got, it really is worth thinking about whether the capital gains tax saving from the base cost uplift on death. So what I'm talking about here is when you pay your capital gains tax on the sale or transition of an asset, you're paying it on the gain between what you bought it for normally and the value at that point. When you die holding that asset, that original cost, as it were, is rebased to the market value at the time of death, which is really significant by way of capital gains tax planning. And could that be worth suffering the inheritance tax in the longer run? And potentially that is right for some people. So it's really that time for reflection and working out what your succession plans are. And if you've got a business or agricultural property that's worth over 1 million, it is absolutely a time to reflect on what do you want to achieve, and is this still fit for purpose? It leads me quite nicely into just covering the capital gains tax questions quickly for you, or capital gains tax changes, I should say. An increase was widely speculated, but it was less than had been anticipated. The lower rate was increased from 10 to 18%, and the higher from 10 to 24%. It was effective from 30th of October 24, and there are anti-forestalling provisions regarding contracts that were entered into before that date that might still be subject to the new rates. So just watch out for that if you had any transactions spanning that time. But the other thing to mention is that the business asset disposal relief that we had still exists. It was called entrepreneurs relief, or it was it replaced entrepreneurs relief, and those that remember it, that replaced business asset taper relief, if you remember that one. So we still have that, and that gives us up to £1 million of qualifying gains, can be taxed at this 10% lower rate, but that rate does increase to 14%, 14, from 6th of April 25, and it increases again to 18%, 18, from 6th of April 26. So that tells us there's something to be thinking about there in respect of if there were transactions someone was thinking about. It might make sense to be considering whether a sale can go through to secure that 10% rate before it goes up to the 14% on the 6th of April. So I would ask Paul at this point, where we have got business owners that are considering a sale, and still might be very much considering the lower rates that we potentially still have, what do they need to think about? So can you give us an angle from an M&A perspective on what those business owners need to think about?
Yeah, of course. Thank you, Zoe. And I agree with a lot of what you've just said, that there is a much wider view to the market than just the tax rate. I mean, I think the M&A sector generally has been pretty challenging over the last few years. We've had one economic or political challenge after another, and the last year has really been impacted quite heavily by interest rates and inflation rates being so high, and I think that's caused a lot of people to pause and just reflect before entering into any M&A, whether that's acquiring or selling. But what we've really seen since probably about May this year, and post the election, is an increase in activity from both buyers and sellers, and I think that's come from both a bit more political certainty and a bit more economic certainty. What that's led to is quite a lot of conversations on my side with people saying, well, is now the right time to sell? And I think that is an eminently complex question that relates a lot more to just what the tax rate is. It is absolutely true that you will pay more tax today than you would have done 3 months ago, and with the change to business asset disposal relief, there will be more tax again to pay post April 25, and then again post April 2026. But I don't think this should be the key driver in terms of what your decision making is. I think, and you talked about this earlier, Zoe, think really carefully about your long-term objectives. What's your plan for the business over the next few years? Because frankly, if your plan is to double the business in the next 12 months, then the right thing to do is probably not to sell it now, because the value you will take out of it, even with the increased tax rates, is going to be higher in a year's time than it is today. That said, if you're thinking about stepping down and maybe you want to spend more time with your family, then maybe it's now is a good time to be thinking about selling your business. And I think this is especially true given that we've got 4 or 5 years of a Labour government, and what might happen to tax rates over that period of time is definitely a question mark. So for me, thinking about long-term plans, where you want to take the business, is really, really important. we'll help you through what the tax impact of that will be. But I think it's bringing the combination of the commercial issues plus the tax that will give you the best chance of making the right decision. So for me, it's about taking into account the tax, but not just solely being driven by it.
Yeah, thanks, Paul. And that's as a tax person, I completely agree with that advice, and I think Ian does as well as a tax partner. And just to touch on those sort of changes from a capital gains tax perspective, I think just some things to put in people's minds, if it is appropriate, is you've got things like the opportunity to defer or remove capital gains tax get on gains as appropriate. So thinking about things like EIS investments, CDIS investments, you've got spousal transfers. One of the ones that comes up, I'm asked by clients is, should I leave the country? That comes with its own complications. But actually, when you're thinking about things like that, having a holding company and thinking about which entity are you selling and separating what you're doing on a potential transaction to your own personal residence and getting the timing right of that can work. But it's really important to then be consulting with your M&A advisor about what your buyer might want and the timings around that. So there's lots of things that can go together to come up with a plan here. And I think the other thing I would mention is do be thinking about holdover or gift relief from a capital gains tax perspective if you are thinking about the inheritance tax as well, but also thinking about that difference between selling and locking in a capital gains tax position on a gain versus paying that inheritance tax charge, whatever it might be, on the value at death. Is going to come up with different answers for different people, but they are calculations worth doing and understanding that exposure. So we can touch very quickly, I think, on a point that Ian mentioned earlier, because I think it's going to be relevant to the business owners that are joining us today, and that's just about HMRC compliance. We've got a couple of stats that we could share with you around how that's evolved. And Ian's nodding. Ian, did you want to cover these stats, or should I cover them?
Happy for you to cover them, Zoe.
You look like you were ready to go, and I know you were doing it earlier. So
they're investing a lot of money, though, aren't they?
They are indeed. And so the numbers I've got for you is they are HMRC compliance and debt collection staff are intending to raise 1.4 billion next year, rising to 6.5 billion in 29-30. I'm just giving you that number again, 6.5 billion in 29-30. So a significant amount of extra tax from this sector. And so Ian's comments earlier, I think, are really put in perspective when you mention those numbers. The other one to just put in your minds is an increase of 1.5% on the interest paid on late paid tax. So if you're paying corporation tax through quarterly instalments payments, this is quite relevant here for our business owners to be thinking about. So just a few stats and things to get you all thinking.
Yeah, I'd say just on that, Zoe, as well, they're looking at adding 5,000 more compliance officers over the next few years. So that's another thing just to be mindful of where you haven't had a review recently, because they are likely to want to come out and see you. So.
You always have the stats at your fingertips. I know, Ian, it's quite impressive.
About that.
So we've had some questions through, which, to be honest, are a really nice way for us to be able to help the people that are on our webinar. So I'm just going to throw these out, and the three of us can comment as appropriate. If you have any more, please do put them on the Q&A section. So the first one we've had is, and I'm mainly looking at Paul, but I'm sure Ian and I will join in. If I sold my company in late April 24 and tax is not liable until January 26, will my CGT be affected? I said Paul, but actually I guess it's more tax. It's me, isn't it? I started reading thinking it was a sale question, and then no, it's onto a tax question. So I can give the answer to that. So if it's a completed contract, so that we're not talking about a deferred issue or any uncompleted contracts, then it would be the date at which you did it. So April 24 in this scenario. So late April 24, that would be in the 24-25 scenario, January 26 as the question asked. So I would not be expecting you to be affected by these changes to capital gains tax. I think you would be affected in due course if you decided to invest that in another business, and whether now is the time to do that or not, that would be a poor question. But no, these changes that were affected on budget days, that's 30th of October.
And Zoe, would that count if it was a deferred or an earn-out payment, for example? Is it just when the contract's completed rather than when the payment's received?
Trust Paul to ask me a tricky question, but a brilliant question, I must
Apologies.
say, which wasn't planned. So it's a really important one, because if there's any element of deferred or earn-out, so what we would be expecting is that would be valued effectively at the time that takes place. It can be a difficult thing, but a value's got to be attributed to that, and that's what you would be putting on your tax return and taxing at the time according to the rates that were applicable at the time. If in due course you had, that value was too low, and therefore you got additional revenue that you were not expecting that exceeded the amount that you'd originally taxed, you would have that coming into charge at the rates applicable at the time. So that's going to be a really important consideration for people when they're thinking about that value for any form of earn-out, is really making sure they're getting that right, and it's falling at, in this example, so the April 24, at those lower rates as opposed to the higher ones unnecessarily. That's just a really, really good question. So I'm going to go to a Paul one, because I'd set him up for one, so I think that's the right place to go. What change do you consider will have the biggest impact on M&A? Paul.
It's an interesting one. I think that I think the easy answer is to say that, for those people who are considering selling their business, given that the rates have gone up and there is going to be an increase in the rate under business asset disposal relief, I suspect that will have some impact on people who are thinking about selling the business over the next 12 months. Will be thinking that if I can do that before the end of this tax year, before the business asset disposal relief rate goes up, I will save myself some tax. So why wouldn't I do it prior to April 2025 rather than post April 2025? So I certainly think and it's probably maybe a relatively limited group of people who are thinking of selling the business in the short term, I think there will be a rush to do that, or a relative rush to do that before April. I think the second piece, which is the longer term view, and you were talking about that, the impact of IHT on transferring businesses that are family owned, I suspect actually that will have a more material impact, given that the rates of tax we're talking about are much, much higher. So I think if an owner of a business was thinking about just handing it down to his children or her children upon death, I think that there is a materially different impact now to what it would have been a month or so ago. So I think that will have a very material impact on owners of family businesses thinking very carefully about what they want to do with the business going forward, because the potential for paying a material greater tax balance, I think, is much higher. So I can see that being a real critical issue for family-owned businesses who are going to pass them down to their children.
Thank you, Paul. Okay, a slightly different question here, which is going to come to you, Ian. With the expected rising costs to employers, do you have any wisdom on retaining quality staff while keeping the cost low?
I think there's lots of things that can still be done. At the top end, where you can qualify, there are still some advantageous share scheme options available, like EMI, which could be useful here. You've also got things that may appeal more to your broader kind of employee base, I suppose. So like I mentioned before, if you've not done salary sacrifice for pension, that can increase net pay, can also save national insurance from the employer. Things like electric vehicles are popular for organisations to offer to their employees, as are things like, looking at how you can exchange pay for extra holiday, extra annual leave, or cycle to work arrangements. They're still protected from the optional remuneration charges that were put in 2017. So can still be, good ways of mitigating tax and national insurance, whilst also enhancing your reward strategy and program as well. So there are some things there to look at. I did touch on apprenticeships earlier as well. They're not just for people out of school at 16. They can go throughout everyone on this call could be on an apprenticeship potentially. And that means you could potentially be drawing on your apprenticeship levy that you've paid, or some co-investment funding from the government if you don't have a pay bill over 3 million, to actually pay for large elements of that training provision. As I mentioned before, if they're under 25, the qualifying apprentice as well, you can save national insurance there. So these rises, whilst not welcome by businesses, there is some mitigation there, and there is a way of thinking about how can we reward employees slightly differently. For other clients, I've looked at other things. So we may think, well, can we give like a working from home allowance? You can give £26 a month if people work from home regularly, tax and NI free. What about what we do around, beneficial loans? Do people need a loan because of bills increasing at home? Give up to £10,000 without there being a P11D charge on that, from an interest perspective. Obviously, they would need to pay the loan back at some point. To looking at, things like, vouchers at Christmas time or a hamper. Still get a lot of questions around that. You can give up to £50 for a Christmas hamper or voucher to say happy Christmas, happy birthday, for other reasons as well that aren't connected to rewarding performance. So there are options available to employees and employers, albeit you're not going to completely get rid of the increases in costs, particularly that secondary threshold bomb that was dropped on budget day.
It's an interesting point, isn't it, Ian, that just what might seem like small things actually can really make employees feel valued, and then really help with the retention policy. And when you can do that tax efficiently, what a brilliant way to go about it. Two more questions that were submitted prior to today, and then we've got a couple more that have come on during our session. So one of the final questions is, what are some of the implications for international businesses? And we could probably cover that from all three angles, actually, from an M&A perspective, employment tax and private clients. So Paul, do you want to kick off with thoughts there?
Yeah, and I think taking this from a non-tax perspective, I suspect that particularly with the political change that we've seen over the last 6 months, both in the UK and the US, we're going to see quite a bit of interest from buyers looking both internationally to expand their businesses outside of the UK, but also from international buyers looking to buy in the UK. I suspect that the impact of interest rates and growth on exchange rates is going to have quite an interesting impact on the attractiveness or not of buying in certain countries. So we have seen, particularly with the sort of relatively weak pound over the last sort of 2-3 years, we have seen a great deal of interest from the US buyers coming into the UK. I suspect we'll continue to see that. But I also suspect that some of the UK businesses will be looking to expand overseas to take advantage of perhaps better growth opportunities elsewhere, if that's what they see, or vice versa. We'll see other European buyers coming into the UK to take advantage of opportunities here. So I suspect to see more international M&A over the next 2 to 3 years than we have maybe done for the last 3 or 4.
Thank you. Ian, any thoughts from an employer perspective?
I think from my angle, it's more a case of that, there are rules around where you pay tax and social security, where employees and workers are traveling inside and out of the UK, can also impact your permanent establishment depending on who is doing work and where they are doing it to. So really do pay attention to where individuals are working from and how often they're coming over here. Some key things to build in if they're coming to the UK are get a short-term business visitor agreement in place for those workers. Think about whether everyone should be on the payroll, particularly directors. Non-resident directors is an area that HMRC could happily target, I would imagine, given the information that's held at Companies House if they do some fun tech stuff to get the data. So, be aware of it and manage it, I would say there.
Excellent, thank you. And the final comment I'll make on that from a private client perspective is we have evolving rules from residents and a domicile perspective, and actually making sure you know where you are resident, and the exposure that you have in respect of not just income tax, capital gains tax, but inheritance tax, and making sure you're planning for that is really important, and think about how that might impact on the business is crucial, especially if you're thinking about going in due course of an exit of your business and how that might look to a seller, etc. So it's really, we come full circle here, but it's we talk about international, that they are some of the really key points from a business business owner perspective to be mindful of, do you trigger those residence tests here or elsewhere, and how does that fit together? So the one more question we've got that was pre-submitted is asking about the impact on business owners exiting their business and the impact on them, whether through sale or voluntary wind up when they retire. So I think we probably, during the course of our discussions, have covered these in respect of the changes to capital gains tax that existed. But Paul, I don't know if you've got any other comments that you wanted to make on that.
No, I think only to say that again, you should be really thinking about commercially and also the overall impact in terms of equity value and cash in your pocket post transaction as to working out what the right transaction to do is. I think it's very easy to think, well, here's a great way I can save myself 4% tax or 10% tax or 20% tax. But actually, if that ends up putting less money in your pocket, I think you have to question very seriously whether that's the right thing to do. So first work out what your commercial and personal objectives are, and then between the three of us we can work pretty clearly to work out what the right way to then dispose of or exit or crystallize the value in your business is going to be.
Thank you, Paul. Okay, a couple of questions that we've had on the Q&A. So the first one, I thought there were items in the budget to prevent transfers post the budget date to reduce inheritance tax, etc. I don't know if that is perhaps a question in reference to the comment I made regarding gifts out of income are still available, potentially exempt transfers are still available, and that is the case. So you can still be making transfers during lifetime. We don't have a gift tax. Other countries do. You do need to consider the capital gains tax exposure. That's the flag I would raise there. But from an inheritance tax perspective, should you want to pass down during lifetime, you can do that. And the final question we've got, if a husband dies and the shares in his company go to his wife, what will be the base cost of those shares for the wife? So you would be expecting on a spousal transfer, which is free of inheritance tax, and we still have that. There are some complications if you're not both domiciled in the same place historically, but if we put that to one side for the second, you would expect no inheritance tax on a spousal transfer, and you would expect a capital gains tax base cost uplift. So what I mentioned earlier, in respect of what those shares would be subject to from a capital gains tax perspective in this example, when the wife would perhaps sell them or pass them down in due course, which is one of those areas that I almost wondered if might be addressed in the budget, that you get double relief, as it were. And it was one of those areas that you could have seen, I could have expected they would say, if you're getting spousal transfer, you don't get the base cost uplift. But they didn't do that. So that's the answer to that question. So that's all we have by way of questions today. So we can start to wrap up if there are no more coming through. So I'd really like to thank you all for joining us today. And if you'd like any more details on anything that we've covered in today's webinars, please just get in touch with your usual contact or on our website. A recording of this webinar will be made available on our website, and a copy will be sent to everyone who's signed up, and you're very welcome to share this with your colleagues if you'd like to do that. You'll also have the opportunity to sign up for our other post-budget webinars, where we'll go into more detail on how the budget announcements impact your personal wealth and for non-domiciled individuals, which we've only touched on very briefly here today. Finally, you can sign up for our Next Economy and Investments, which will feature George Lagarius and Ben Seagar-Scott. And finally, just a thank you to Paul and Ian for joining me today to discuss these topics. And I hope you all have found it useful and enjoy the rest of your day. Thank you.
Thank you, Zoe. Thank you, everyone.
Thanks, Zoe.